Chapter 14, Tax Credits. The following forms and publications are used in the research and development of this lesson. Forms and publications are available at www.irs.gov. In this chapter, students will learn that a non-refundable credit affects the taxpayer's tax liability. When the student has completed this chapter, they will understand how non-refundable credits can lower the tax liability. The IRS defines various tax credits under non-refundable or refundable. The ones in this chapter will be non-refundable credits. If you have tax liability, you may be able to apply tax credits to reduce that liability. If you have no tax liability, there is no credit to apply. And that becomes a challenge with clients as they sit down if with low income, they also may have daycare benefits to be able to deduct, but their income was low enough that they had no tax liability. And again, the term tax liability, we discussed in the previous chapter how you arrive at taxable income, and then there is the tax tables that you apply to taxable income to arrive at a tax liability. This is how much tax you are going to pay this year. Now, that does not mean you're writing them a check to give and send with your tax return, because we're going to apply next any qualifying credits, refundable or non-refundable, as well as apply any payments such as what was withheld from their checks throughout the year. So that still certainly is implying a potential refund, and a possible large refund. So we use the term tax liability to mean there is some tax to pay there, whether or not they actually write a check to the IRS balance due when we're done. So with that tax liability, a non-refundable credit can be applied and can lower their tax liability. The obvious objective is to arrive at a zero tax for the year. And that is a good definition here of what a non-refundable tax credit is. It reduces the amount of tax liability for the taxpayer that may be required to be paid. Unlike a deduction, which reduces the amount of income subject to tax, a credit directly reduces the tax itself. So it's a balance. I like to think of it as a balance, a scale. So we have on one side of the scale the deductions to lower taxable income to arrive at taxable income. We calculate the tax. On the other side of the scale, then, we have credits to apply to lower the tax liability. The credit will only reduce the tax liability to zero, but not below zero. So it's always a challenge when someone has daycare expenses to deduct, but they already have a tax liability of zero and therefore cannot apply anymore. So here's a list of the non-refundable credits that are available. Child and dependent care expense credit, education credits, retirement savings contribution credit, child tax credit, and foreign taxes paid. Eligibility for all credits. Credits are not available to married filing separate taxpayers. That's one very important point to keep in mind when someone wishes to file separately. Advise them they don't qualify. That category, married filing separate, does not qualify for credits. Education expenses must be paid for the taxpayer, taxpayer's spouse, or taxpayer's dependents. You'll have clients that want to deduct the education expenses for a child that is no longer a dependent, and you have to explain to them that they don't have the right to do so. There is only one credit can be claimed per eligible student for education. That means you could have multiple children in school. Perhaps you are in school as a taxpayer and your daughter is in school. There is then a credit for both, but only one per each. You can't do both. No double dipping is how the IRS calls it. Now, there are some phase-outs when modified AGI reaches certain limits. The limits vary between being married or head of household or married filing jointly, and it varies between credits. So you want to be sure to check under the instructions of 1040 and specifically to whichever credit you're going to apply to determine what those phase-outs are and to see if your clients continue to qualify for them. If it's married filing separate, that's easy. The phase-out is 0. No credits are allowed. Child and dependent care is a common one when, of course, you're dealing with families. You must use Form 2441. It can be up to 35% of the expenses incurred. The maximum benefit is $3,000 of expenses per child or $6,000 for 2 or more children. It's potential that you could have, if the benefit or the amount of expense, daycare expense, is less than $3,000 per child, then of course you can include more than 2 children, 3, 4, however many. The key is no more than $3,000 for 1 child and no more than $6,000 for 2 or more. And they must be a qualifying person of yours. They must be your dependent for you to be able to claim that. The other key is that if married filing joint, both parents must be employed. If one parent is not, as a stay-at-home mom, is a homemaker, then any daycare expenses are not deductible and don't qualify for the credit. Now, the spouse that is not working could be a full-time student. In that case, then they would still be able to qualify for the daycare. They can be a full-time student, or if they by chance are physically or mentally disabled or unable to care for themselves. The other issue is that earned income for each month is considered to be at least $250. So even if the spouse is not working a lot, maybe part-time, again, the bottom line, as long as it's at least $250 per month, that's enough to be able to qualify to take the dependent care credit. You also must provide the information on the daycare provider, the caregiver, name, address, social security number, and federal ID number if it's a business. And individual states may require more. Here in California, they require the phone number. Now, what happens a lot of times is a client will come in, they've got the daycare, and then you mention, well, I need the provider's name, address, social security number, and they look at you, oh, you've got to have their social security number? I said, yes, if you don't provide the social security number, the IRS will not provide the credit. And many times they'll say, well, never mind then. Whether they don't have a social security number, or the other question is, well, do they have to report that as income? And so, well, yes, they do. They may not have tax to pay on it, but yes, it becomes taxable income to the provider. And so there are times when they will say, well, then never mind, we don't want to include it. But that's fine, that's up to them, but you want to make sure to make that clear. They cannot do daycare without that social security number. And if the provider can provide a W-10 that has the details of their federal ID number, their name, and the amount that was paid per dependent, that's great. Here's what a Form 2441 looks like. It's for, again, 2012. By the way, I'm not sure if I had mentioned, had you noticed below where it has the year 2012, attachment sequence number 21. This is a clever way for you to, if you're mailing in your return, to know how to organize your return and mail it in. You put the top form, 1040 or 1040A, or whichever form applies, and then you sequentially put in the schedules and additional forms behind there in the proper order, staple it and mail it in. Now for daycare, here again, the care provider's name, address, federal ID number or social security number, the total amount paid, and then below there you will list the dependents that qualify for it. One key important note is they must be under 13 before you can declare and receive this daycare credit. And usually, and it's interesting difference, usually an event occurs in the year it happens. For instance, you can claim a child as a dependent whatever time, whatever day they were born in a given year. So in 2013, even if the child is born December 31st of 2013, and when you do the taxes for 2013 next spring, you can include that child as a dependent, even if they weren't born until the very last day. Also, date of death. If a spouse dies during the year, even if it's the last day of the year, then you change next year, not this year, your filing status. That is not so when it comes to daycare. So you can deduct the expenses you incurred in daycare up until the actual day that they turn 13. So if my son's birthday is October 24th, so I can do and include my daycare expense up until October 24th, but not for the rest of the year. Education credits are a very big item today. The biggest one that there is out there is American Opportunity Credit. That is the primary one used. There are a lot of restrictions. It's very important to review all the details of it. Primarily, they must be a full-time student or at least a half-time student, and that you need to find out exactly the definition of half-time student. They need to have a declared major. It needs to be within the first 4 years of college. It does not include high school or below. It is not for postgraduate. It's for the 4 years of undergraduate work when they attend college. It can be per student. There's a maximum benefit of up to $2,500 with credit with a refundable portion of 40%. Or up to $1,000. So we've seen some abuse of that this year and people putting down education credits that don't apply for it and don't qualify for it. So very important to look for that. And also the key is what is deducted. Clients will come in and they will want to deduct the gas and the car and the room and board for college expense. And the only college expense that can be included in the education credits is tuition and certain fees for attending school and textbooks. But there's also a limitation and specific on textbooks. It must be only when the only option you have, the college requires you to purchase the textbooks only from them. You don't have any other option to buy them elsewhere. Those are some really strict regulations. And there are other specifics that you need to make further research to determine. But the cost of college these days, it's usually not an issue to have to do a lot of research because then usually tuition and textbooks ends up equaling in a year far more than the maximum expense deduction benefit, which is $4,000. Now, if a person is not full-time in school or has graduated and is in graduate school or is taking a training course, or my son is up taking an extensive first aid course, 10-day full-blown extensive 10-day course near the Bay Area. That can be deducted not under the American Opportunity Credit, but it can be deducted under the Lifetime Learning Credit. That's the advantage of that one. It's only 20% up to a maximum benefit or credit of $2,000. It is only non-refundable, no refundable portion, but it is another option for education credits. If there is a job-related education requirement that you have to pay for and are not reimbursed, that also could be included under Schedule A itemized deductions, job-related expenses. Another one we point here is tuition and fees deduction that we spoke of in earlier chapters under adjustments to income. Now the key on either one of these is any credit you take can only be applied to one of these. No double dipping. So it's either going to be under American Opportunity Credit or Lifetime Learning Credit or tuition and fees deduction. One of the changes they made for 2012 is in the requirement of what you're looking at, Form 1098-T. This is going to show you Box 1, payments received for qualified tuition and related expenses or it'll show up under box 2, amounts billed for qualified tuition and related expenses. This amount is what you can now deduct. The 2012 American Opportunity Credit, and you report it actually under Form 8863, is requiring the federal ID number. So you need to have more specifics. This form gives that to you. You didn't have it before this year. So the filer's name would have, University of Texas, P.O. Box 422, and Austin, Texas, whatever the zip code is, and right below it in that box, the federal ID number. Next to it, the student's social security number, and then the student's name, street, and city, state, and zip. Now understand, it may be more than one in the household. As long as they are part of your tax return, either as a taxpayer or as a dependent, then you can include that. So it could be potential, if you have triplets, that you're paying for all 3 of them, you can get the maximum allowable credits per student. The lifetime learning credit is not so. It's a maximum benefit of $2,000 per the return, not per student. Very important distinctions there. So now what happened this year was people were not necessarily bringing in this 1098-T form, and in the past it wasn't as needed. That we could put in proximities. They would remember how much they had spent for the year. We could include that and it was fine. But this year they're requiring now the federal ID number, name and address of the school, and what student went there. So this is very important form for the clients to bring in. It will identify the exact dollar amount. One other box to keep an eye out, and that is box 5. Scholarships or grants. It's many times there may be, for instance, $5,000 in box 1 and $10,000 in box 5. Now in that situation, as their scholarship is far greater than their actual charges for the year, there is no credit to be able to take. They didn't spend any money out of pocket. You could ask about textbooks just in case, but chances are good in my example, textbooks aren't going to be enough to be greater than what the scholarship. And in usually that case, I will ask the client, now did you actually have to spend any money out of pocket? 9 times out of 10, all they would say is, well, I had to pay for their gas or their computer, or I had to pay for their car. And of course, those are not deductible. One key note on the computer: a laptop is not a requirement necessarily for completing a course. So very important that you distinguish that. I can't imagine doing college work these days without a computer. But at the same time, if it's not a requirement of the school, then it's not a deductible credit on the taxes. There is another called a retirement savings contribution credit. Now, many people don't necessarily qualify for this, but a few do. Those have to do where their income is lower. So if they are contributing to a 401k, for example, and their income is less, up to $34,000, if married filing joint, as you're looking at the chart, then they could qualify and receive a credit. It's a small amount of credit. The maximum usually I've seen is about $200, but it's an incentive to put money in a retirement account even when your income is low, especially when your income is low. So its credit is based on the first $2,000 contributed. Taxpayer must be at least 18 years old, and Form 8880 is used to calculate the credit. Another big one this year, big changes this year, is child tax credit. For many years, child tax credit has been available. It's been wonderful, I myself, with 2 kids, to receive that extra $1,000 per child additional tax credit. Wonderful. Very nice to enjoy that. Sadly now, my youngest is 17 and no longer qualifies. There is that limit. So first thing to consider with child tax credit is eligibility, the amount of the credit, what credit limitations there are, the child relationship to the taxpayer, and if there are any phase-outs. And there are phase-outs. You can make substantial amount of money to the point where you don't qualify anymore for any of the child tax credit. $120,000 begins the phase-out for married filing joint, and therefore you would not get that. Eligibility is crucial because, first of all, they must be a qualifying child, but then they also, unlike dependency qualifications, they must live with you. So we go back to, as we looked in previous chapters, the tiebreaker rules for a qualifying child of more than one person. So if more than one person files a return claiming the same qualifying child and only one person is the parent then is the one who has the qualifying child. But one key difference, and these tiebreaker rules are great for dependents. You know, a dependent doesn't necessarily have to live with you, but you are still providing over 50% of their support, which means you have the right to claim them as a dependent. But for child tax credit, and that is the difference this year, especially if the child has an ITIN, individual tax identification number, the IRS even asks in the child tax credit, one of the key questions is, do they live with you? Literally more than 50% of the year, more than over half the time, in the home. They must have lived with you. Many people have been claiming, in this part of the country, been claiming nephews and nieces who actually live in Mexico. So it is important to ask, do they live with you? If they say no, then they still can be your dependent, reducing your taxable income, counting as an exemption, but they don't qualify for the child tax credit. And it's critical that you, as the tax preparer, ask the question, do they live with you or not? And if they say yes, then just advise them the IRS may require you to prove that. Well, how do I prove it? Well, you can give them some examples, but ultimately the burden of proof is on the taxpayer. Another one is foreign tax credit. Now, if your clients already have itemized deductions, it's a better place to input the foreign tax credit is under Schedule A, itemized deductions, part of the taxes you pay, Section 2 of the Schedule A. But yes, there are still requirements for eligibility, amount of credit, credit limitations, forms needed, and requirements. So very important to review all of that. Generally, what you will get are clients that through either stocks sold or dividends paid out will have a little bit of foreign tax paid, shows up in a specific box under 1099 DIV or 1099 INT or even your 1099B from your broker. Look in that box, foreign tax paid, and then you can apply that to either foreign tax credit as a non-refundable credit or under Schedule A. Well, this concludes non-refundable credits. Do Chapter 14 online review questions and the TPAs. You need to pass with a 70% or better, and be sure to read Chapter 15. Thank you.